Welcome back to Investing Talk Podcast.
Great to be here.
Our mission today is pretty focused. We're taking a look at Applied Digital Corporation. And the big question on everyone's mind, really the goal of this whole analysis is Applied Digital a good buy right now?
Yeah, that's the key question. Lots of moving parts with this one.
Definitely. We're going to try and cut through some of that noise, looking at recent catalysts, the core financials, market sentiment, all based on the research you sent over.
Sounds good.
And hey, before we really jump into the details, if you find this helpful, please do remember to subscribe, like, and comment.
Yeah, engagement really helps.
Absolutely. And if you've got a specific company you want us to look into next time, just leave us a comment below.
We do read those.
Okay, so let's unpack this. Applied Digital. They've certainly grabbed a lot of market attention lately.
Oh, for sure. Mostly because they're positioning themselves right in the middle of that explosive AI infrastructure space.
Right. And looking at the research, it feels like there's this real split, doesn't it? Between the momentum story and maybe some of the harder financial details.
That's a perfect way to put it. There's a lot of excitement, and then there's the balance sheet reality.
Let's start with the excitement then. It seems rooted in their recent performance and just this whole AI tailwind strategy.
Exactly. I mean, look at the fiscal fourth quarter results, the ones ending July 2025. Revenue was up significantly.
Yeah, I saw that number, 41.3% year-over-year growth. That's pretty impressive.
It is. And that kind of growth is exactly why analysts are, well, quite enthusiastic.
You see multiple firms reaffirming bullish outlooks, right?
Yeah.
It seems like there's a strong consensus buy rating overall.
That's correct. You've got Needham & Co. with a $16 target, Craig Hallam even more bullish at $23.
Wow, $23.
Yeah. So, the market's definitely pricing in some serious potential upside there.
But it feels like those expectations aren't just based on, past revenue. It's more about the scale of what they're trying to build now.
Absolutely. That's the core of the sentiment driver right now, the sheer scale of the expansion they're attempting.
You mean the Polaris Forge 2 announcement?
Precisely. Announced back in August 2025, and they're planning to break ground this month, September 2025.
And this is a massive facility, right?
Oh, yeah. We're talking about a $3 billion, 280-megawatt AI data center campus up in North Dakota.
$3 billion.
It's cited in the sources as one of the largest new AI data center projects in the entire U.S.
So this isn't just incremental growth. This is like a step change attempt.
It really is. It suggests they're trying to move beyond being maybe a niche player and really lock down core infrastructure capacity for AI.
And the market certainly seemed to buy into that narrative back in August.
They definitely did. That announcement was a huge catalyst. Shares rallied almost 20%.
19.4%, I think it was.
Yeah, right around there. And it wasn't just the price action. You saw a noticeable uptick in bullish options flow, too.
So it felt like that perfect storm, AI hype meeting actual concrete expansion plans.
You got it.
Okay, but that news is kind of in the rearview mirror now, to some extent. So this is where it gets really interesting for someone considering buying today. What are the next, hard drivers to watch, say, over the next 3 months, October to December?
Right, looking ahead. Well, there are a few specific things, kind of institutional events to keep a close eye on.
Okay.
First, you've got that Polaris Forge 2 groundbreaking. That's confirmed for September 30th. That's just around the corner.
Okay, so that's a near-term milestone. What else?
Then around mid-October, maybe October 15th or so, there's the potential for the stock to be included in various ETFs.
The quarterly rebalancing effect.
Exactly. It's more of a technical event, but that kind of forced buying from ETFs can drive demand and increase liquidity.
Makes sense. And the big one, I assume, is earnings.
Always is. Fiscal Q1 2026 earnings are scheduled for November 7th. That'll be a crucial update on execution and maybe guidance.
Okay, so those are the hard dates. But beyond that, there's a lot of speculation swirling around, isn't there? Persistent rumors.
Oh, yeah. The rumor mill is definitely active. The main one seems to be about a potential major strategic AI partnership.
Like with a hyperscaler? Is that what they mean? Someone like Microsoft, AWS, Google Cloud.
That's the speculation, exactly. That would be the dream scenario for them, right? Lock in a major cloud player to basically pre-lease a huge chunk of that 280 megawatts at Polaris Forge 2.
That would certainly help justify that $3 billion price tag quickly.
Absolutely. Securing a long-term contract like that guarantees recurring revenue and de-risks the investment significantly.
Any other rumors?
There's also been some market chatter, maybe less concrete, about potential M&A activity.
Applied Digital buying someone else, you mean, to accelerate their scale?
Yeah, potentially acquiring smaller firms to get operational scale faster. Again, it's just chatter for now, but it's part of the narrative.
Okay, so that's the bullish story, the momentum, the potential catalyst. But now we need to connect this back to the bigger picture. All this rapid growth, this huge expansion, it obviously comes with significant costs.
Right, and that's where the enthusiasm needs a dose of financial reality. We need to check that.
Let's look at the snapshot for fiscal year 2025 then. That seems to provide the critical counter-narrative.
It does. So while that revenue number, $332.2 million, was robust, like we said,
Yeah, up 41%.
the company actually posted a net loss of $47.1 million for the year.
Wow.
And the estimated diluted EPS was negative $0.25.
Hold on, how does that work? Revenue up over 40%, analysts setting targets way up at $16.23, but they're losing almost $50 million. That feels like a huge disconnect.
It is a disconnect on the surface, but it's actually, well, typical, although still highly risky, for these kinds of high-growth data center firms in their early, heavy build-out years.
So the losses are expected to some extent.
Yes. That negative profit margin, estimated around minus 14.2%, it's a direct result of massive capital expenditures, CapEx, and all the ramp-up costs.
They're spending furiously to build these giant facilities.
Exactly. Long before the consistent recurring revenue starts flowing in from clients using them.
Okay, so that naturally raises a big question about their financial health during this massive build-out phase. Looking at the balance sheet from May 2025, things look a bit tight, don't they?
Yeah, tighten's a good word. Total debt was around $375 million.
$375 million in debt.
Mostly secured term loans, and against that, they only held about $86 million in cash.
Oof. $86 million cash versus $375 million debt. That really highlights the liquidity strain they must be under.
Precisely. And this is reflected directly in their estimated debt-to-equity ratio, which is about 1.1x.
How does that compare to others in the sector?
It's above the sector median for cloud infrastructure companies. It definitely signifies elevated leverage risk right now.
And why is that DE ratio so critical at this moment?
Because if anything stalls, if Polaris Forge 2 construction gets delayed, or if landing that big hyperscaler contract gets pushed back, that large debt load dramatically amplifies the risk.
They absolutely need those recurring revenues to come online.
They need them to stabilize the margins, start generating positive net income, and service that debt. It's critical.
So consensus estimates are essentially betting everything on flawless execution then.
Pretty much. The street expects revenue to climb towards, say, $420 to $450 million in fiscal 2026. But crucially, they must transition into positive net income.
And that's entirely hinged on getting those major hosting contracts signed and the facilities up and running on time.
100%. It all comes down to execution and timing.
Okay, let's shift gears a bit and look at what the market signals, the charts, the institutional players are saying. Sometimes the market prices risk differently than just the raw fundamentals suggest.
True. And technically, right now, the momentum actually appears bullish.
How so?
Well, the shares are currently trading above both the 50-day simple moving average, which is around $15.30, and the 200-day SMA, down near $13.90.
Okay, so that indicates some strong short-term momentum.
Yes, and that's reinforced by the MACD indicator, which showed a bullish crossover in mid-September.
But what's the key takeaway on the technicals? Because it feels like this stock moves around a lot.
That is the key takeaway. High volatility. The 30-day realized volatility is currently over 40%.
Wow, over 40%. That's a really wild ride, even for like a high-flying tech stock.
It absolutely is. So while you see some strong support noted down in the $13 to $13.50 range, which might act as a floor.
There's resistance overhead.
Yeah, resistance seems pretty stiff, up around $16.50, $17. The stock has tried and failed multiple times to break cleanly above 17.
Okay. And maybe that volatility is amplified a bit by some of the insider actions we've seen recently.
That's certainly possible. We have seen sales reported from both the CEO, Wes Cummins, and some other director transactions as well.
The CEO sale is pretty significant, wasn't it? 400,000 shares.
Yes, 400,000 shares sold in early September, right around $15.26 per share.
Hold on, let me just connect those dots. Analyst targets are $16, even $23.
Oh.
But the CEO sells a big chunk right at 15.25. Isn't that?
Yeah.
Well, isn't that a pretty big red flag?
It's definitely something you have to factor into your analysis, no question.
It kind of suggests the person who knows the company best maybe sees the ceiling right around where those technical resistance levels are.
It could suggest that. Now, insider selling can sometimes be routine, executives selling vested equity grants for diversification or tax planning.
Sure, that happened.
But the timing here is notable. It's happening alongside that high leverage profile and after a period of strong stock price momentum.
So it suggests maybe the CEO felt the current valuation was a pretty good time to take some profits off the table, rather than maybe believing that $23 target is just around the corner.
That's one interpretation, yes. It warrants close monitoring.
Okay, but we need to balance that insider view with the institutional side, right? Who are the big holders?
Right. And despite those insider sales, there is significant institutional backing here. BlackRock reported holding 5.7%, Hood River Capital with 5.6%.
Some big names are still involved.
Yes, it reflects prolonged interest from both quantitative funds and private capital. It suggests these larger players still see a compelling long-term story, likely focused on capturing that AI infrastructure dominance.
So they view the current volatility, the leverage, maybe as just the cost of entry for potentially massive scale down the road.
That seems to be the institutional thesis, yes. They're willing to ride out the turbulence for the potential long-term payoff.
Okay, so this brings us right back to that core tension we identified at the start. Massive growth potential, secular tailwind from AI.
Right, countered directly by high financial risk, the debt load, the negative cash flow during this critical ramp-up phase.
The stock-specific risks seem almost entirely centered on execution, right?
Almost entirely. The number one risk factor is just the successful, timely ramp-up of these new facilities, especially Polaris Forge 2. It's just so big and so critical.
And the debt load just amplifies any stumbles there.
Exactly. If revenue realization stalls or margins don't improve as expected, that debt becomes a much heavier burden. And the high sector volatility just pours gasoline on that fire, making it a very event-driven, bumpy ride.
So if you had to synthesize all this, based on the materials we've reviewed, maybe give it an overall rating.
Yeah, putting it all together, the investment thesis summary probably lands somewhere around a 6.5 out of 10 right now.
Okay, 6.5. Why that number?
Because the strengths are undeniable. You've got that rapid revenue growth, the direct exposure to the AI boom, those bullish short-term technicals.
Right.
But the weaknesses are equally clear and, frankly, quite pressing. You have the negative net income, the negative operating cash flow, that elevated leverage we discussed, and you can't ignore the recent insider selling.
Right. So what does this all mean for you, the listener, who might be considering buying Applied Digital right now? How should you approach this inherent tension?
Based on everything, the assessment really leans towards this being better suited for short-term trading at the moment.
Trading, not long-term investing.
Because the high variability, the sensitivity to news and these specific upcoming events, the groundbreaking potential ETF inclusion, earnings, it all suggests the stock is currently better for active traders who can potentially capitalize on that volatility.
And long-term.
Long-term investment only really becomes attractive if, and it's a big if, their execution succeeds. If they hit their timelines, secure the contracts, and start showing that recurring revenue stabilizing margins. Probably looking out beyond fiscal 2026, maybe into 2027.
So patience and risk tolerance are key for a long-term holder.
Absolutely. You need patience, you have to fully acknowledge the execution risk, and you must be prepared to tolerate some potentially significant short-term price swings while you wait for that profitability picture to hopefully emerge.
Okay, so summing up.
Yeah.
We've seen the exciting growth pipeline, the absolutely critical role of Polaris Forge 2 in their whole strategy. But we've also had to lay bare the reality of the negative cash flow and the high leverage that really defines this aggressive expansion phase.
That's the crux of it.
Applied Digital's competitive advantage seems to rely completely on their ability to scale up fast, secure those long-term power deals ahead of everyone else.
That's their play, speed and scale.
Right. So considering the really significant debt they're taking on to fund that scale, the final question for you, the listener, has to be this.
Yeah.
Does that potential payoff, the dream of cornering a piece of the AI infrastructure market, does it truly outweigh the very real heightened risk of execution failure or liquidity strain during this make-or-break ramp-up phase?
That's the decision point right there. Risk versus reward in a high-stakes game.
Indeed. Well, thank you for joining us for this analysis on Applied Digital Corporation.
My pleasure.
We really hope this knowledge helps inform your next decision, and we look forward to diving into your next requested topic soon.